All right, hi everyone. Great to be back. I haven't done a business risk index webinar in quite some time, so it's nice to take the reins again. We're going to look at the June results. There's obviously plenty happening. June's always a very or somewhat volatile month, both for the ASX or share markets, but also from an insolvency perspective. And of course, with everything going on with interest rates and inflation, coming change from an RBA governor as well, there's no shortage of things out there that are happening. So let's jump into it. For those of you that are new or only hearing about CreditorWatch for the first time, CreditorWatch is an end-to-end credit management solution or a credit reporting bureau. You may understand that term a little bit better. For three main things that we provide, we can help you onboard your customers faster in a more efficient way. And of course improve the customer experience on their end. We can automate the decisioning, we can provide the credit reporting, alerts, monitoring, etc. So you have a really good sense of what a customer looks like up front or a prospect, and we'll keep an eye on them ongoing, providing you with alerts if anything important changes. And along the whole way, we have a collection solution as well. So once you onboard them as a customer, you start issuing invoices. Let us help you automate that process, provide you with workflows, send out reminders, and ultimately collect those payments for you, while you're doing your normal day job or while you're sleeping as well. There's nothing better than getting paid while you sleep. CreditorWatch data, where do we get the data from that powers our reports, powers our credit ratings, powers our business risk index, which is why we're all here today? We get it from two main sources, common data and unique data. The common data are typically government sources like ASIC, the ATO, Australian Business Register, courts, AFSA, which provides bankruptcy information. And on the left-hand side there, you've got our unique data. So payment defaults being registered by our customers against their debtors, mercantile inquiries. So we've got hundreds of debt collectors using us to chase, obviously, overdue debts that are referred to them. We've got credit inquiries, we've got transactional information that shows you how a business is ultimately paying their bills, really powerful information. And of course, we also look at the geo-risk and geo-demographic data inputs as well to understand, if businesses are struggling in certain locations or looking for really key insights into organizations that have got, for example, one director versus three directors. What does that mean from a credit risk perspective? So Annika's provided a little bit of information on the economic outlook. So I'll touch on that very briefly. I think what's really challenging, and I've said this before, either in the news or via webinars and articles, you wouldn't really want to be a central banker in today's economic environment. There's insights, data points coming out on a daily, weekly, monthly basis that contradict one another, and it's really tough out there. And you can see that despite the huge number of interest rate rises over the last 12 months, not just in Australia, but across the globe, we still have this really challenging inflation problem. But hopefully, we're starting to see some good signs, and we'll be talking about rate reductions in possibly the next 12 months. One of the things that Annika, our chief economist, has called out is that there is a really narrow yield. There is a really narrow spread, I should say, between the bond yields. So for 3, 5, and 10 years, usually there would be a more of a gap, given if you are on a 10-year bond, that they would likely be a lot higher than a 3-year, given there's such a uncertainty between 3 and 10-year time frames, but they've all come really closer together. And Annika's feels that the RBA's done a fairly good job over the last few months to narrow the path to a soft landing. However, there's still a lot of uncertainty out there as we go forward, and I think that the risk of a technical recession is certainly a real risk. But I think we've moved past a sustained recession being in place for a longer period of time, which is really good. A key number that's out today is the unemployment rate, which will be really important and will certainly move both the yield curve and also either put pressure or relinquish pressure on the RBA around future increases of the cash rate. Employment growth is still very strong, which is fortunately a bad news, but is also good news as well. You know, we know that full employment means that a longer term recession is unlikely, but full employment also puts pressure on inflation and makes it more difficult to bring down. If we look at some of the advertisements though, we can see that there is a lot more pressure on employment than there was, 12 months ago. So the year-on-year change, this is looking at the number of ads, for example, in certain sectors, comparing it to 12 months ago. So overall, they're 22% down, which is, what the central bank wants to see, but there's still, strong demand for jobs as well. No surprise there that the top two are those that are really exposed to discretionary spending. And then as we come into winter, there's obviously a lot less jobs out there, given Australia is typically more of a summer destination rather than a winter destination. All right, let's jump into the data insights, what we're seeing across those key delinquency, key insolvency events that we're obviously reporting on within our credit reports. They affect our credit rating. And of course, if you are monitoring your customer base, for example, we will send you an email alert when one of these events are triggered. If you've got tens or tens of thousands of customers, very difficult to keep track of all of them 24/7. So let us do that job for you. So payment defaults continue to trend upwards, 50% increase year on year. You typically would see over the last couple of years, June being bigger than May, but if you went back a little bit further to sort of pre-COVID, you would see that May is usually a bigger month, and it can come off a bit in July. We expect this to continue to go up. While it looks, it is significantly above sort of pre-COVID levels, we still think this will sort of settle probably 20 to 30% above pre-COVID, and then sort of plateau or slightly trend downwards over the next 12 months. Of course, a lot of pain being felt by businesses out there, particularly in the SME world. And we've got some fantastic stats on defaults being registered. There's a really high correlation between a default being registered against a business and that business ultimately going into administration within a sort of 12 to 18 month period. So if you do have companies that you're either monitoring that you receive a default against, or you're running a report and see a default already against that particular organisation, it's certainly a cause for concern for the future. External administrations obviously reported on heavily within the media. They continue to trend upwards. While it's slightly down on last month, it is a 13% increase on year on year. We are getting back to that normal operating rhythm where we are seeing the same sort of number of insolvencies administrations as we saw pre-COVID, which is a good position to be in, despite the fact that there is a lot of noise about increases taking place and they're shooting up really fast. The fact is that they're going back to where they were, and it's really important that we have a normal insolvency cadence within the economy, because ultimately you need to pay your bills. If you don't pay your bills and there's no downside to that, like an insolvency, why would you pay your bills at all? It also, affects and ensures that, there are stronger businesses obviously survive. Resources, people are then, less diluted and focused on to better quality businesses that aren't going into administration. So while we certainly don't like to see people lose their jobs, creditors not get paid, and people lose their businesses, it is a fact of life that businesses do ultimately go into administration. And if we can get back into that normal routine, that normal rhythm of that sort of 800 to 900 businesses going into external administration every month, then that's a positive. We think they'll sort of go above about probably 10 to 20%. Of course, in certain other industries, they'll go above, well above their normal sort of pre-COVID insolvency cadence. And again, similar to defaults, that will sort of probably trend upwards for another few months and plateau before coming down once we get some certainty around interest rates and inflation certainly starting to come down themselves as well. Credit inquiries, what we're hearing from the market is that CreditorWatch customers, or credit inquiry is performing a credit check on a business within CreditorWatch. What we're hearing is companies are doing more and more credit reports, not just on companies that they're conscious of, aware of, or worried about. They're doing it across their book. So doing regular reports on existing customers, but also we're seeing a big increase in the number of companies applying for credit with plenty of companies as well. So the reason for that is credit policies have certainly been tightened over the last 12 months, and as a result, you'll see businesses, typical debtors, go to one organisation, maybe only be offered, a $5,000 or $10,000 credit limit, but what they're after is, a $20,000, $30,000, $40,000, $50,000. So they'll go to another supplier of those goods or services, and of course we see that there's a natural increase in credit inquiries as a result of that. Court actions, while they overall are sort of trending upwards, it's a much lighter trend upwards, and there's no sort of huge increase like we're seeing in defaults and insolvencies, but they are starting to go back up to those pre-COVID levels that we're used to. A new data set that we're reporting on now is ATO tax default. So of course, a bit over 12 months ago, where are we? Oh, this is for December. So data started to come through from the ATO where they would lodge a default against companies that owe them money, have not made contact, have not made an effort to pay that, and it's over $100,000 or more. The ATO can now register payment defaults against them. So that's coming into our credit reports and of course our alerts, and there's an even higher correlation between a tax default and administration in the future. So we're reporting on this just from a state-based perspective at the moment. So we're seeing that no surprise that New South Wales is the leader there, but probably on a per business capita perspective is probably lower than what you would expect from New South Wales, and Victoria and Queensland probably taking up a bit more of their share of businesses, as is WA at 11% as well. So we will continue to report on this, and as the volumes continue to increase, and they are going up slowly at this point, the ATO is sort of committed to increasing that, taking their time to register those defaults. We will continue to report on these into the future. The default rate prediction. So this is what we're predicting to see, obviously 12 months out. So this is the observed rate. This is actually what happened, and then what we see is this is where we predicted it 12 months ago, and of course this is what we're predicting 12 months from now. So there's obviously a significant increase that's been baked in over the last 6 months as insolvencies go up, interest rates go up. There's a lot more pressure on businesses out there, but you can see that it is flatlining 12 months out. So we don't see it continuing to increase into the future. We feel that hopefully that 12-month prediction of default or administration into the future is starting to plateau already, which is a good sign. But of course, we will see that big increase in pain, and we'll see a continued increase in insolvencies over that next 12 months. All right, let's take a look at some industry insights now. And of course, I didn't mention this at the beginning, but if you've got any questions, you can use that question and answer box within the GoToWebinar control panel. Please don't be shy, and I'll check those at the end. We've got a rolling annual external administration rate time series. So this is a percentage of businesses entering external administration within that monthly period, and we're looking at that over all the way back to Feb 2018. So you can see that we have rolled back up to pre-COVID levels. You can see there was a natural increase leading into COVID itself. If you can think back that far and go back to sort of late 2019, and we had all those bushfires, before we had obviously COVID hit. It was starting to be a slightly more challenging time than we'd had in those previous 2 years as well. So trending back up there, probably above the sort of 2018 and even 2017 mean as well. I think what's always important to see is the percentage. It is a really low number of companies that ultimately end up in administration every year compared to the overall number of companies that are out there. This is now looking at the total percentage of businesses in each industry that are going into external administration or defaulting over the last 12 months as well. So you can see that food and beverage, 0.9% of all businesses have gone into administration over the last 12 months. Construction is 0.8%, and then it rolls down there through information media telecommunications coming in number 3. Despite arts and rec being, a high risk industry at the moment, there's a small percentage of them that actually go into administration. So this is just a nice new way to understand and look at how businesses are failing. Of course, then we have the probability of default by industry. So this is looking at the probability of a business within a specific industry going into administration in the next 12 months. Food and beverage certainly leading the way, and then it is really flat thereafter. Transport, postal and warehousing, arts and rec coming in 2 and 3, and down the bottom end, the least risky wholesale trade, agriculture and healthcare as well, rounding out the least risky at the bottom 3 there. So it is quite flat, as I said. No surprise that food and beverage is struggling. They're exposed to that discretionary spend. It's typically a higher risk industry, and then what we've seen as well is where the businesses in suburban areas were doing quite well as everyone was working from home. We've now seen a shift back to the CBDs, and therefore the share of wallet has reduced and is actually split between CBD and suburban. So you don't have either of them winning per se, because you do still have this big chunk of people working that hybrid model, at home and coming into the office too. So typically we see the Monday, Friday very quiet in the CBD, but a lot busier Tuesday, Wednesday and Thursday at this point. Payment arrears by industry, and this also looks at how small business suppliers are paid versus big business suppliers. So I'll touch on that in just a second, but ultimately this is looking at the total number of businesses within an industry that are paying 60 days or more in arrears, and that's on average over a 12-month period. So no surprises that construction, by nature of that industry, is a really slow paying industry, but also as a result of sort of progress payments and retention clauses, of course, they're naturally a slower payer as a result of that. Transport, postal and warehousing certainly having its own difficulties at the moment, coming in, I think it was number 2 or 3 on the PD scale, but also really slow paying. And then information media and telecommunications number 3. And then if we look at that small versus large, and CreditorWatch, we talk about this all the time. CreditorWatch has obviously got tens of thousands of companies using us for credit reporting solutions, and that's everything from sole traders, small businesses, all the way up to some of the largest organizations in the country. And what we know is that small businesses, as a supplier, if you're a small business supplier, you are more likely to get paid slower than a big business supplier. And the reason for that is a big business supplier is generally a critical supplier. Think about it this way in very practical terms. If you have a whole bunch of invoices that you need to pay in front of you, you are going to pay your critical suppliers, those suppliers that you are reliant on to trade on a daily basis. And if they took away their service, your business would ultimately be switched off at the same time. So think about landlords, banks, telecommunication or web services, that sort of thing coming in. If that was taken away, those big critical suppliers have that leverage to put pressure on to get payment faster and first. They also are a lot more sophisticated generally in their credit collection processes and techniques, whereas a small business supplier quite often just happy to be able to send an invoice, can be quite reactive to how they collect. They'll do collections on a you know, on a weekend or on a monthly basis, very slow to do that. They can let it go out to sort of 60 days before they start calling and gently asking for payment. So as a result, we see a really big discrepancy between how big business is paid versus small businesses. And of course, that has a knock-on effect onto how small businesses are rated as well, generally a higher credit risk. But importantly, very important to get that whole of economy or whole of supply chain understanding of how businesses are being paid and are paying. And by having that, you get a really good understanding of the credit risk of a business. Relying solely on big businesses to tell you how they're being paid can actually be a bit of a furphy for how the overall view of the economy and of course how businesses are faring through this current economy. So getting that 360-degree view is really important, and I think that's where CreditorWatch does a fantastic job to have this huge number of small businesses using us, medium businesses, corporates, all the way up to the largest organisations in Australia. All right, a couple more time series to call out here for everyone, specifically looking at the construction industry. So you can see, you know, over the last 2 years, there's been a significant increase in the number of insolvencies in the construction industry, getting back up to, you know, those pre-COVID levels, and that will continue. I think what we've also seen historically in the construction world is that where there's a huge amount of work, you find that a lot of employees of construction or building related organizations, be it suppliers or tradies, subbies, etc., will see that there's a huge amount of work. They'll leave full-time roles and they'll move into you know, sole trader or starting their own business, for example. So there's all of a sudden a huge supply comes into the market because there's demand, and then there's naturally, being quite a cyclical industry, a downturn, and you see that work starts to dry up. People aren't paying bills, etc., and those often those same people go back to being full-time employees and closing down their businesses. A lot of them get into business without having, you know, the basics of being able to actually understand how to run a business, how to invoice correctly, how to quote correctly, and collect as well. And as a result, you know, there is naturally a lot more risk in that industry. So we expect that to continue to climb over the coming 12 months. Food and beverage, despite the fact that there's such a high risk, they're certainly still not back to where they were, and it's actually started to taper off in the last couple of months in terms of the number of businesses going into administration in that food and beverage industry. Okay, the last slide we'll look at here, and I think I'm running on time here. Hopefully, there's a couple of questions. Is the regional analysis, and I've just picked out the worst regions, the 10 highest risk locations. This is looking at locations that have got 5,000 or more businesses in them. Of course, no really big changes here at all, as we've been saying for the last sort of 12 to 18 months. You know, that the two areas jumping out that have been sort of dominating the top 10 are Western Sydney, and that remains the case. And of course, the Surfers Paradise, Gold Coast, sort of Coolangatta region as well, that are dominating there. And they're certainly the riskiest areas for businesses to be operating. But of course, this is you know, a really high level view of that. There's no reason why, if you ran a report on a business in one of these regions, you can't find really good quality businesses in there. The same can be said about, you know, the best quality regions can still have poor performing businesses. So of course, we encourage you to run the credit report on the individual business and assess the default rate or the credit rating within that report to understand what sort of risk that business represents to your business. Should they apply for credit, or should they already be a customer of yours? Last little slide, I'll just leave that there for a second, and I will check to see if there are any questions that have come through. No questions, unfortunately. All right, I will ask a question of my own then. If you could just let us know if you'd like to hear more about CreditorWatch's offering or the Business Risk Index. If you're keen to hear more about the Business Risk Index, your first port of call is to jump onto the CreditorWatch website, navigate yourself to the news hub, and there's no shortage of articles for you to ingest there, but also there's some additional data on the Business Risk Index, insolvencies, defaults, etc., that you can jump into and have a look to find out a little bit more information, or we can be in contact as well. So I'll leave that poll open for another few seconds. Thanks to those that have answered. You don't have to, of course, but if you want to hear from us, I suggest you pop in there and say yes. All right, we do have a question that has come through. Can you please provide a copy of the Business Risk Index? Yes, you can access this this slide pack once we have obviously recorded it and sent it out, but also you'll be able to, you can actually jump onto the website and access the latest article on the Business Risk Index. All right, closing that down. Thank you, everyone. Nice and quick today, not too many, only one question, but plenty of you letting us know that you want to be contacted, about 50% of you, which is great. So thank you for that. Please keep an eye out for the next business risk webinar that we do on a monthly basis. Of course, we do an article or press release on a monthly basis as well. And should you want more information, you can jump onto the website to find out information not only about the Business Risk Index and articles that we're publishing on a monthly basis, or a daily basis, I should say, but also about our software, our data, our credit reports, our onboarding products as well. So highly encourage you to go to creditorwatch.com.au to find out some more information about CreditorWatch. Until then, thank you very much, and I appreciate everyone's time and joining us. See you soon.